What's up, guys? Welcome back to DCA. So with Bitcoin right around $40,000 right now, we're going to take a look at a few things to determine whether this is a real move to the upside that we're seeing, or whether we're potentially seeing a bull trap forming. So the first thing we're going to do is take a look at the 21-week EMA. So the reason the 21-week EMA holds importance is simply for the fact that if you look historically at the price of Bitcoin, we can look at on-chain metrics, which actually show that this price, as well as the 20-week SMA, are very similar to the price at which short-term holders own the asset. The reason that matters is because while short-term holders get underwater, so as the price falls below their average price, what we see is that they will be willing to sell the asset as it comes back to that price in order to get out of the trade at an even trade. Rather than taking a loss, they would like to get out at an even place. So you need a lot of buy pressure to sort of move the price back above this level, because you're experiencing a lot of sell pressure by short-term holders as you're coming to this price. In addition to the fact that algo traders are aware of this fact, and you have trade bots activating their sell signals right when you get to this price. And there's just a lot of things working against the price at one of these critical price levels. And the 21-week EMA is one of these very important levels. So if we just go back historically, just to sort of justify what we're saying here, you'll see that in the setting of a bull market, the 21-week EMA as well as the 20-week SMA actually sort of hold the level of support for the bull market. So when you drop below this level, and we're talking about the purple moving average here, when you drop below this level, you're sort of in a more bearish segment of the market, as we saw here in May and then here again at the end of November. And when you hold this level as support, you're typically in a much more bullish segment of the market. And we can go back to 2017 in order to beautifully see this. As we were moving up in the bull market, you saw every time we came down to this 21-week EMA or the 20-week simple moving average, you saw us bounce right off of it, okay? And that is for the fact that this was very close to the short-term holder average price, and we were bouncing off that level because they were buying the dip into the bull market, buying the dip every time we came down. We're at their average price, so they buy the dip, maybe sell some once we hit these peaks, we come back down, etc., until we eventually broke through at the end of January. Now, what you'll see happened back in 2018 is we got back up to this level several times, but we were not able to hold it as support, which is what you need to be in a confirmed bull market. So we got above, but we're not able to hold it as support. We got above here in February, here in April, and then here in July. But you'll notice each time within a week or 2 weeks, we were right back below it and continuing the bear market. Now back in 2018, notice that here in November, here in February, almost in April, then again in June and August, and then finally in November, we were interacting with this support level here. So this is the $5,600 level. It might be actually a bit higher than that, maybe all the way up to around $6,000. What concerns me about the move right now is that we're kind of seeing a very similar thing occur. Now, it's not quite exactly the same because of the fact that, like I said, there are more bullish signs here in that we made a low here at around, we got all the way down to around 29,000. Then we made a lower low here, we're talking closes here at around 32,000. And now this close occurred at around 36,000 on the weekly charts. In addition to that, we've obviously made a higher high, going from our close here at around 60,000 up to our weekly close here at around 65,000. So we've been making higher highs as well as higher lows. Now that's the bullish sign, okay? So we know that. Now let's take a look at what's below us. Well, down below us, we have the 100-week moving average. And we've been above, well above, in fact, the 100-week moving average, basically ever since the COVID capitulation event. And we've been now well above this level for quite a while, but you'll notice that we're creeping towards it. And in addition to that, the 21-week EMA is in a downtrend and in fact descending towards the 100-week moving average. Now, historically, when the 100-week moving average is nearing a place where it's going to cross the 21-week EMA, that is a very bearish sign. So you see it back here in the end of 2014, and then you saw it again in the end of 2018. And while we're not at any sort of imminent place where, this is going to happen in the short term, it's definitely something that we're going to want to watch. So, the good news here is it does seem as though this price has sort of leveled off. Now we'll have to see what happens going forward. If we keep going higher from here, it's very likely that the 21-week EMA will be able to turn around, and we may be able to avoid having a place where the 100-week SMA crosses this 21-week EMA. So what we're saying here overall is we're seeing a place where we're at a very critical price level. This $45,000 level is a high level of resistance, and we're going to need to see ourselves get above it. In fact, you see that we even got rejected here back at the beginning of February. We got rejected right off of this level, and we're seeing the same thing here. So it's going to be an important price. Now, I think we will, if we did come down, we'd likely get a bump off of this 100-week SMA, but then it all comes down to, if this 21-week EMA crosses or is getting to a place where we're going to cross the 100-week SMA, it's historically a very bad sign. And this is true not just for Bitcoin, but for any asset. You could even go look at the stock market or major indices. And, ideally what we'd like to see is ourselves break above this EMA, but do it in convincing fashion. So if we just take a look at this, what we have here is essentially just a simple trend line that we've been forming ever since, the beginning of November. So depending on how you want to draw this, you could draw it something like this or this. Either way you look at it, we've broken above with this wick here on, February 28th. So we've broken above this trend line, and that is a bullish signal. Now, if you just look here, this just demonstrates what I was saying before, how we're making higher highs and higher lows. Now, they're very weak higher highs and higher lows. And, we typically haven't seen many events like this in Bitcoin's history, where we hit a high and then come all the way down to this level, crash below the 21-week moving average, the 20-week moving average, the 50-week moving average, and then are still able to go make a higher high. So, it sort of brings into question of what exactly was happening here. In fact, if we come over here and look, this is the price volume. Now, this is one of the key metrics that I use to determine how much interest is there in the asset. Is there strong support backing up these moves to the upside we see? So what this metric does, it multiplies the price times the volume. Why do you do that? That's because the price times the volume is telling you how many dollars are being transacted on the asset. And when you have an asset class that, goes from anywhere from, nearly $70,000 all the way down to the high 20,000s, looking at volume alone is almost useless, because it's obviously easier to trade more shares of an asset that, is half the price that it was, several months prior. So what we need to do is look at the price volume, because that will tell us how much money, how many dollars are actually being traded on the asset. Okay. And what we see actually is the fact that let's just look at the percentage change here. The price volume change so the price volume, the number of dollars being traded on the asset, it's actually down 87% from our peak back here in January. So you saw this bearish divergence occur back in January, where our price volume was falling as the price was still continuing higher. But the key is, you'll notice that as the price volume was falling, so was the momentum almost. So we were going up, but it was very sluggish. It wasn't this, explosive move that we saw back here in the, the end of 2020 into early 2021. you lost that explosive movement. So what you're seeing now is just this slow sort of grind downwards in terms of the volume. In fact, if we just draw a trend line, you can see that, we haven't even got close to this upper end of the trend line, which basically is what you saw. Your volume is going to peak at certain places, and these will include extreme parabolic moves to the upside as well as capitulation events. So you see the extreme move to the upside here, and then capitulation events here in May, and then here in December. So this is another reason that, back all the way going back to November, it was sort of concerning, the move we were making, because of the fact that yes, our volume was increasing, our price volume was increasing, but overall we weren't seeing a very strong move to the upside. Okay, and now let's go back to 2018, and you see the same thing. As the price was falling all through the bear market, you were seeing your price volume trail off. So here's our peak. You see this strong move to the upside in terms of price volume, and then it just sort of trailed off. Then we had a peak, another peak for this capitulation event that occurred, dropping us from around, $6,000 all the way down to around $3,200. So you saw a peak there, and then it sort of built back up ever since that time. But now what you're seeing is we're trending down again. So we need to see this pickup, or I suspect this move to the upside is just going to flounder out. I mean, there's almost everything that you see shows that if your price volume is falling, your price is going to be falling. So this metric is a way of assessing an asset that spans a wide range of prices like cryptocurrency does. And so it's sort of a way of standardizing what we're looking at and gives you a more even view rather than just volume, which is highly skewed. Okay, so if we just quickly look at volume here, you'll in fact see that your highest volume ever for Bitcoin was back here in 2013. But we know that the amount of dollars being spent on the asset back then was dwarfed in comparison to where we're at now. Okay, so we're looking on a log scale here. If we just look on a linear scale, and we'll fit it. So this is where your highest volume was back in 2013, right here. But now look at how many dollars are being spent on the asset. You can't even see this anymore because the amount of dollars are just so much higher now. But look at, and compare your volume. So compare your volume here, where this massive peak is, compared to your volume here. There's no volume here. There's massive volume here. But that's irrelevant. That's why your volume is irrelevant in cryptocurrency, because it's comparing apples to oranges, essentially. It's comparing a $500 Bitcoin to the volume of a $60,000 Bitcoin. They're not comparable. So that's why looking at the price volume is what you need to be doing. All right. So the last thing we'll quickly look at, and this is perhaps, one of the more interesting findings, but it kind of goes right along with price volume. We're looking at active users on the network. And again, this is a metric which we have never seen, while it's falling, the price make any sort of sustainable upside movement. So we're seeing this fall, and while it's falling, the price is falling. So these are the active users on the network. We'll just make it a moving average here to smooth it out a bit. And you'll see that ever since this peak back in 2018, the active users fell, and then the active users just sort of trended sideways for a while until 2019 came, and we saw the increase in active users occur into this peak here. But then there was another big sell-off, and those same retail investors left the market until later in 2020, after the COVID capitulation event. We saw the active users rising sustainably into the peak that we hit in January, and then through April, and then it just plummeted in May. So this plummeted down. We broke this upwards trend line, and now we were going up for a while into November, but as soon as the November sell-off hit, just take a look at the active users. It's just catapulted down, and we've been trending down, making lower lows and lower highs, and we did make this point right here. We kind of got back to around this level, but ever since then we've actually gone on to make a lower low. So, this is something I'm watching. You know, I think this is something we're going to need to continue to watch. But if at the end of the day, if you don't see this, start to trend back up, if you don't see the price volume start to trend back up, if you continue to see this volume stay anemic like this, there's just no way that the price is going to sustainably increase. So even back here in July, what we saw was the price trending up, but your price volume was slowly trending up as well. But now you're just kind of seeing this downward pressure in the price volume. So, that's not to say this can't pick up, but at the moment it's looking like there's a lot of signs that this could be a fake out. Now, with that said, I'm going to continue to dollar cost average because that's how I approach the asset class. But, that's not necessarily how you're going to approach it. So, arming yourself with the knowledge of what's going on and understanding, what you need to be watching for. So, essentially, you want to see this price volume go up in a big way and then spike through this upside here if you're going to believe that this is a sustainable rally to the upside. Otherwise, there's a lot of ways that big money players can manipulate this market. And, until I see something to suggest to the opposite, that this is not being manipulated and this is a true move to the upside, at best, I would say that we're going to be trading within this channel. Now, there's a lot of upside left to be had in this channel because if you look at the top end of the channel, it goes all the way up to around $70,000. So it's not to say that, we couldn't continue up from here. And remember, if Bitcoin continues to trend up to this upper level at around $70,000, altcoins are going to absolutely explode. But at the end of the day, if this continues back down or breaks down, or even worse, breaks below this orange line, the asset class is going to be in a lot of trouble. So these are the things I'm watching. At the moment, as long as this level is, we're not seeing active users or this price volume increasing, I'm going to remain suspicious. I could be wrong, but that's why I dollar cost average. So I approach the market by decreasing my own personal volatility by every Friday. I dollar cost average, regardless of what's going on, unless we've reached a price where, I'm starting to sell the asset. So that's it for this one, guys. Until next time, as usual, see you.